All right. Well, everybody, thanks for joining us tonight. We are blessed to have Kaaren Hall, who is the founder of uDirect, IRA Services. And I've been a customer of uDirect for quite some time now. I self-directed my IRA, quite a few years ago, and have been using it to I do private lending. I own mortgage notes inside of it. I buy into some REITs and some other stuff. But we're going to learn a lot more tonight with Kaaren on how we can use our IRAs to do real estate. Not just put money in the stock market. So, Kaaren, I'm going to turn it over to you, and if you could just, for those that don't know you, I'm going to let you kind of give your own bio and tell a little bit of background about who you are and how you got started, and then however you kind of want to run it, I'll let you go for it.
All right. Let's see how this works then. Well, thanks a lot. And guys, I really appreciate you inviting me. I sure do miss going to Denver, but maybe we'll be all traveling again soon and get to go up and do that. But yeah, so right. uDirect IRA Services. I founded the company. We're in our 12th year, if you can believe that. So it's great. We've helped thousands of people self-direct their IRA. But my background, professionally, first I was a radio announcer, and then I made the logical transition into real estate. Like, I think if everybody, I could see everyone's face and I said, like, raise your hand if you did something before you did real estate, everybody would raise their hand because it's something that you kind of are drawn to. And then I professionally, I was a real estate agent for a year, kind of got my fill of that, and then became a property manager and managed a lot of buildings in Seattle. And so did that for a while, and then got in mortgage loan servicing for some years. And then from mortgage loan servicing, got into origination for probably another 8 years. And then, of course, then we had the big crash. And when that happened, then I'm like, what do I need to do something else? And so every one of those skills that I ever acquired was perfect for this self-directed IRA business, because I can do public speaking, and I understand, the note business and the real estate business. And I've just done so many different aspects of it that I could really speak the language. So it just was a natural fit. And it's been going great. I mean, I think I started initially in 2007 in self-directed IRAs, and then founded uDirect in 2009. But I mean, we all have our stories, and it's super fun with real estate. I don't know, this isn't my story, but I was in Texas for a while, and a friend was an appraiser and was appraising this property, and was like kind of an older property, and going through and found, and then his foot went through the floorboard on the stairs. You probably have been through one of those houses, and the whole house was infested with snakes. This is real estate. It's what we love. Yeah. So how Texas is, where they have the brick houses with the little weep holes on the bottom. Mm-hmm. You may be familiar with that. Well, some little baby snakes got in there somehow, and they just became a whole family. And so, but just, real estate, we got to love it.
That's awesome.
And it's, brick and mortar, we can touch it. So that's what's great about self-directed IRAs, is that that you can invest in real estate in so many different forms, like you're doing, Stu. You've got performing and non-performing debt. You've got brick and mortar real estate, which has its own special, things to be aware of, and of private placements where somebody is going to take down like a whole multifamily property, for example. I mean, pretty much most people don't have 2 million or more in their IRA, because you've got these small contribution caps. So it's hard to get that big in an IRA, but you can invest in that through the private placement. You've got crowdfunding, and then SEC governs all that. So it's Reg A, B, C, and D, and you can use that if you're accredited to get into deals, as you know. So, but the self-directed IRA picture overall, it's like I think of it like you said, okay, we're going to play a game. Then I know all of you guys here, you're going to be like, okay, how do I win? And that's the first thing you're going to want to know. If we say game, you're how to win. So that's what we're going to tell you, how to win the self-directed IRA game. And I think one of the first things is to set the right expectations. Like, what should you even expect out of self-directed IRAs, right? So I don't know what you expected when you got into it, Stu. Was it pretty much like you thought?
Yeah, I think so. I mean, I think the biggest thing for me that made my decision was just being able to have the control over my investments, and not worrying on somebody else to make investments for me. And so that's what I love about it.
Yeah. Well, and the best thing about it is what you're doing, and you're doing yourself such a great favor, your future self, is that you're building all this wealth for later on when you're really going to need it, because self-directed IRAs obviously are for retirement purposes. So you don't get personal benefit today. You're not going to take money out of your IRA and use it for right now, but just going to build this gigantic nest egg. So when you hit, well, right now the age is 59 and a half. And when you hit that age, you can take the money out penalty free. I mean, if it's a Roth, you get it tax free. So that's even better. So that right. This is how you play to win is you first off, you just realize that this is all about retirement and saving, right? And at the same time, you get to have some fun. Maybe you'll step into some snakes. I don't know.
Right.
But there you'll have your own stories. But you also get to help people too. If you think about it, like if your IRA is making notes, like you said, you're doing some lending, and you've got, somebody maybe in your real estate investment club is they've got a project and they need a little extra cash maybe to finish a rehab or something. Your IRA can come in with the extra float that they need, and then you get paid a little bit when they close, and everybody wins. It's a real good grassroots way of bringing everybody up in the industry too, I think.
Yeah, for sure.
And when it comes to being an asset sponsor, somebody where you've got the asset and you're raising capital, this is where a self-directed IRA is super, super powerful too. Because if you know about it, which after you finish this event tonight, you're going to know about it, then you realize that you can tap into $31 trillion, a pool of $31 trillion of retirement money for your deals. So if you have a project and you're looking for capital, then you just say, hey, do you have an IRA or do you have a 401k with an old company, a previous company? They say yes. And then they said, hey, you can take that money and invest in my deal. And most people will be pretty astonished if they haven't heard about it before. And it's still a best kept secret, even though it's been around. Get this, self-directed IRAs have been around since 1975. Wow. And I think most people on this program tonight were born after 1975. I'm going to say it's nothing new, right?
Yeah.
Because it sounds like something new. It's like, I never heard of this. A lot of people who are like fund managers, or I should say, like they work at places like Fidelity or Merrill Lynch, or if they're into the stock market, they may not have even heard of a self-directed IRA. Okay, so we're going to play to win and set expectations. So the one thing about self-directed IRAs that's so different than it is with any other kind of investing is that some people can be disallowed or prohibited or can't play the game. And those people are your lineal ascendants and descendants. I like to think it's up and down the family tree, right? Like your parents and grandparents and their spouses, you and your spouse, and your children and your grandchildren and their spouses are disallowed parties. Plus a 50-50 business partner or any fiduciary to the plan. Like a fiduciary is somebody who has an obligation to act in your best interest, like maybe a realtor or an attorney or CPA or something like that. So those people are disallowed. So let's put this all into perspective. So we're going to play the game to win. We know who the players aren't. They're not disallowed people, but they can be your brothers and sisters, your aunts and uncles, your cousins, nieces and nephews. So it's not that your family can't participate. It's just where they are on the family tree. All right. So we know. So those are the players. And then when it comes to our side, the players are, first off, you have uDirect IRA Services, the best company in the world. Okay?
That's right.
And going from us, we use a trust company custodian, so your money is in a trust company, and so they're like our kind of our back office in the sense that we're your point of contact. Sort of like when you get insurance, you go to your insurance agent. Although we don't have an agency or relationship like that, but it's they do the money and handle all the cash management on the back end. So we use a trust company custodian. But there's you, and that's why we call it uDirect, because you, the account holder, are driving the whole bus. You're choosing what to invest in, and you're choosing, what assets and what terms. The IRA is just a tool in your tool belt for being a real estate investor. Okay, so that's how that works. So now we've got the players on both sides. Now the rules are it's a game of keep away. Like, how do I win? You keep away from prohibited transactions. And that's what we spend a lot of our time doing here. We'll get phone calls and people will say, oh, I'm looking to do this, and can I do this? And we'll talk to them to listen for a prohibited transaction. So I'll get into that a little bit more. But prohibited transactions, if you want to read about them, if you're a rule book kind of person, you can read about these prohibited transactions in the Internal Revenue Code. Sounds fun, right? IRC 4975.
Nope.
But hey, there are a lot of lawyers and rule book kind of people out there, so that's where you find it. IRC 4975. And that's what you can't do. So basically, you're not going to have none of these disallowed people can have personal benefit or present benefit or indirect benefit from the IRA. It's all about later. So your IRA invests, those proceeds are for retirement purposes only. If you just remember that, then you're okay. So here's an example. Maybe you've got money in your self-directed IRA and you're thinking, oh, my spouse is trying to open a business. So maybe my IRA could fund a loan to my spouse so they could start this business. Well, the answer is no, they're a disallowed person. And so if your IRA makes a loan to a disallowed person, they've received benefit, personal benefit, game over, prohibited transaction. And it's a good part or a good time to stop and talk about prohibited transactions. So with prohibited transactions, what it means is if your IRA commits one, it is totally game over for your whole account. It ceases to be retirement money. Can you imagine that? You've got
wow.
So say you've got like 500,000 in your IRA, and you've got 100 in a note and 100 in a private placement, and you're doing this and that, a couple hundred in a property, and you make a prohibited transaction in one of those assets, it's game over for the whole account.
That's crazy.
Yeah, you get 1099 for your whole account if you do this. So we spend a lot of our time talking to people before they open their account to say, tell us about your deal. So that's what we really want to know. And by the way, if you've got questions, please type them in the chat box because I would love to answer like any particular. But we're always saying, hey, let's talk about your deal. So here's a deal. I talked to this one really nice couple, and so they're going to both open an IRA. They both open an IRA because they're disallowed to each other. Remember, and they're both going to open what's called an IRA-owned LLC or a checkbook IRA. You probably heard about that, right? Yeah. You can talk about it a little bit deeper. So here they've got husband and wife, IRA-owned LLC, and they're so excited about this deal. So I was speaking at this event, and they showed up, and at the end of the event, we sat down at the table, and I said, and they were so meticulous. They had this like perfect handwriting on their little notes, and they just wanted to do it right so much. And so they said, well, we're so excited because we found this industrial property and it's in this, we're getting this awesome price and we're getting a really good deal and we're so excited. My IRA-owned LLC and her IRA-owned LLC, the two, they're gonna co-invest. And here's the thing, when disallowed people invest together, they can do it as long as they invest concurrently, like you record at the same time, right? Then it's okay, that's like a loophole in the rule. Disallowed people can invest together as long as they do so concurrently.
Interesting.
So it sounds great. So husband and wife, they're going to buy this industrial building. It's all fun and games until it's like this always happens. Like it's right at the end of the conversation when they throw the bomb, the prohibited transaction bomb. And they said to me, well, yeah, we're so excited because we own the property next door. Wait a minute, how is that a prohibited transaction, right? You could take a stab at it if you want, but a lot of people just leave them scratching their heads like, why is that prohibited? Well, as we know in real estate, when you buy a piece of property, you set the value, you set the market value, right? So your IRA buys a piece of property over here, you own this property over here. The minute somebody improves their property, then your IRA just benefited, you just got personal benefit from your IRA, you see? So that's what would make it a prohibited transaction. And there are other things like easements or appurtenances or easements, pretty much where there could be personal benefit. So you have to just steer clear of that prohibited transaction. Another kind of prohibited transaction, back to the rule book, is that disallowed person can't provide goods, facilities, or services to the plan. And what that means is that, like say, David, you're a realtor maybe, and you think, okay, this is really great. So what I'm going to do is I'm going to buy this this piece of property in my IRA, but I'm a realtor, so I'll get this really great deal if I just write up the deal myself. Or you can't do that. Not only can you not take a commission for doing it, because that would be personal benefit, but you also can't write up the deal through your broker, because that would be offering services to the plan, even for free, right? So you have to just steer clear of prohibited transactions. And that's what we're here for, to chat with you about it, before you get into your deal. Maybe you've got a fund and you're raising capital through like some sort of Reg D offering or something. And you're a thought leader in that situation, in that deal. And so what you're thinking you're going to do is that you'll have your own self-directed IRA, invest in your own fund. Well, you can't, because you're a decision maker. Any C-suite decision maker can't be investing their self-directed IRA in that deal, because then they'd get personal benefit from that.
Matthew just asked, does holding multiple self-directed IRAs reduce the risk to assets if you commit one prohibited transaction in one? So if you do it in one, does it affect all the others if you have multiples?
It doesn't. That's a really good question, because here we start talking about asset protection. I was just talking to an asset protection attorney this morning about this very thing. So you can, yes, having different IRAs. By the way, there's no limit on how many IRA accounts you can have. The only limit is how much you can contribute, like write a check out of your own checkbook for. There's no limit on how much you earn. And there's also no limit on, there's no limit on any of it. So that's pretty cool. So yes, having multiple self-directed IRAs is a great idea. And also, if those IRAs have IRA-owned LLCs, the LLCs can offer some level of asset protection too, as like you have, Stu, and can also give you more check writing authority. But right, it's the same thing. It's prohibited transactions, but there's also other risk. So if you own a bunch of properties, putting each one in a self-directed IRA might make sense, especially if you don't live in California, because here we pay an $800 fee every year to the Franchise Tax Board.
Nice.
But in Denver, I don't think you do. So it depends on where you live. But if you've got a separate account for everyone, and say your tenant slips and falls, and usually asset protection, like the first line of defense, is usually insurance. But after that, it could be an IRA-owned LLC. So we have a list of IRA-owned LLC attorneys that we work with. We're happy to provide that to you. You shoot me an email if you want the list. It's info@udirectira.com, and I can get that to you, no problem.
Cool. Yeah, I'll post your contact information in the show notes. I'll send this out to everybody afterwards.
Okay, good. So we talked about, who are the players and what are the rules, and it's a game of keep away from these prohibited transactions. That's great. And we sort of touched on the IRA-owned LLC, so I'll go into that a little bit. It works like this. You have an IRA that's open and funded, and then you have a third party create a special purpose LLC. That's what's called the checkbook IRA. So your IRA the IRA is like the umbrella, and the LLC is an asset under the umbrella. So the IRA owns the LLC. So first you open the IRA, then the IRA buys the LLC. So which comes first, the chicken or the egg? It's the IRA first, then the LLC. And so that works really well. Your LLC, you open a special checking account for it. And so then you get check writing authority. And as long as you don't commit a prohibited transaction, you're fine using that. But it is an asset of the plan. And every year, just like any other alternative asset, we're going to need you to give us a value of that every year. So you'll need to report the value to us every year, and then we report it on to the IRS. So that is a very high level view of the IRA-owned LLC. If you've got questions about it, we could go a lot deeper.
So one thing that I just learned about from our CPA was that you can so a lot of time, I think one of the challenges with people that have self-directed IRAs is you'll invest some money into a deal, or join a sponsorship or something like that, but you always have a little bit left over in your IRA just kind of sitting there, right? Or you'll put in the $6,000 for the year, and then you don't know what to do with that. And so our CPA said that what she was doing with her leftover money was her and a good friend of hers, and then a business partner of theirs, like they were creating an LLC, and their IRAs were all becoming part owners of the LLC to basically combine their IRA funds to have enough to then go do kind of a bigger deal. And I didn't realize you could kind of take combined funds within IRAs to create an LLC and then go invest.
You can. I mean, you have to make sure that you are following all the SEC's rules, because when you start to pool money, the SEC likes to know about that. But yeah, I'm sure your CPA was all buttoned up about it because, you know, they're a CPA.
Yeah.
I'm sure they're doing it right. But yeah, you could absolutely do it. So the IRA owned LLC, though, is a special purpose LLC. And when it's a single member, it's disregarded for tax purposes. So it doesn't file like a 1020. It doesn't file that tax return every year. So there's that. Gotcha. But it's a great tool. It'll probably get audited when the IRS has enough money to come through an audit. It's low-hanging fruit because there's so many prohibited transactions in that kind of deal, or in those kinds of arrangements. But it's a tool you can use, and we allow it. A lot of self-directed IRA companies won't touch it, but we do allow it.
Nice.
Another thing about self-directed IRAs, it's probably the number one misunderstood thing, is that an IRA can actually borrow money. So people kind of get the cart before the horse, and they think that the IRA is the down payment, and it kind of is, but really it's the IRA is going to own the asset. The IRA can go get a loan, but it's not like a Freddie, Fannie, VA, FHA kind of loan. It's conventional conforming, nothing like that. It's more of a commercial loan, and that loan is called a non-recourse loan. And what that means is that if the IRA defaults on paying back that loan, that the lender can only come against the asset that they lent on, not against any other assets in the account. It's not like a prohibited transaction where it blows up. But with, in this situation, when an IRA borrows money, for some reason the IRA doesn't pay, the lender just comes and seizes the property, and there you go, in worst case scenario. But non-recourse lending, they usually require a lot more money, skin in the game, and maybe a higher down payment. And I do also have a list of non-recourse lenders that I'd be very happy to share with everybody. If you'd like, again, email me at info@udirectira.com. I can send you that list as well.
So basically what you're saying is you can take money that's in your IRA and go buy a rental property and use your IRA money as a down payment, but then get a non-recourse loan to fund the rest of the deal. And now you own a rental property or a commercial property or whatever inside of your IRA, and everything in there is going to be tax-free.
That's a good point. No.
Okay.
So let's talk about that.
Okay.
It is income tax-free, but when your IRA borrows money, there is a tax, a special tax. Yeah. Yes, you got it. UDFI, unrelated debt financed income tax. So you have your CPA work up a 990T. Like you and I, we do a 1040 when we do our taxes. The IRA files a 990T. But then your CPA can, take the deductions out, and maybe you don't owe any tax, if you've got enough deductions. So you just really, like with real estate investing, you always want to begin with the end in mind, and, pencil that out ahead of time. Like, hey, I'm going to borrow, and I'm going to do this. But also too, you're going to have typically about 70% of your IRA is going to be IRA money, 30% is going to be borrowed money. And if we go with that scenario, say here comes $1,000 rent check. Well, say for example, $300 of that check your IRA earned because of leverage, $700 it's because of you saved. So the UDFI tax is only against the $300 that your IRA earned because of leverage.
Gotcha.
So if you want to read more and go deep on these there's also uBIT for unrelated business income tax when your IRA invests in an active business. You could read about it on the IRS's website. It's irs.gov, and it's publication 598.
It's like you have that stuff memorized. It's pretty.
Well, yeah, I've been doing a little bit, and they've been revamping. Now we've got a new administration, and they're revamping some of the publications. So you may or may not be able to read that right now. Like the IRA rules are in publication 590, Pub 590, and so it's been split up into 590A and B, and those are being edited right now. So last time I checked, they're offline, under construction.
So, one question that I have about that, the UDFI and the UBIT, like a lot of investors that do already have IRAs and they're thinking about investing into like syndications. there always is that question of, well, am I going to get taxed for, UDFI and UBIT? I mean, how do you like, as if you're the sponsor, how do you respond to that?
Right.
Because you don't really know like what they're going to get taxed on, do you?
Well, you kind of do. So if you're an asset sponsor, you've got a syndication, you're raising capital. If you're taking on debt in that syndication, that is going to flow through to the IRA holder. It'll be reported on the K-1 that the IRA needs to pay UDFI tax.
Okay.
If your IRA is invested in a syndication, that syndication's taking on debt, your IRA will owe this UDFI tax.
Okay. All right. Gotcha.
So sometimes what you can do, instead of being an equity partner in that syndication, maybe you could be a debt partner. Maybe your IRA could loan money at a certain rate, and then there's no tax because it's a loan and it's not an ownership like a membership.
Gotcha. Okay, that makes sense. Yeah, I like that. And the other thing that I know a lot of people ask me about with specifically owning property inside your IRA. Mm-hmm. And correct me if I'm wrong, but how I understand it is like everything, like every expense, like everything has to come from money inside the IRA. Is that correct?
Yeah, it is. And you can pay your account fees personally. And if you create an IRA owned LLC, that's a one-time fee to pay the attorney to set up the LLC. Usually you can pay that out of pocket. But you're right, any asset-related expense has to be paid for by the IRA. Otherwise, guess what? Prohibited transaction. So okay. You don't want to break that bubble. So, like, what if your IRA runs out of money? I think that's the next logical question, yep. Right? So there's a list of about 5, 6 things you can do. Like, say, for example, your IRA owns a house that needs a roof, and you don't have enough cash in the IRA. So what you could do is you could make a contribution, and the amount of that contribution is dependent upon your age, your account type, and your income. So we've got something on our website about contributions you can read, or talk to your tax advisor, get some good tax advice, make a contribution. If you already did, or that's not an option, and you have money in a different IRA account or an old 401k, you can move that money into the account. It'll take a couple weeks, week or two to get the money in, but you could bring the money in from other retirement accounts. So that's another way. You could take on a debt partner into the IRA too, if you want to do that. If your IRA has other assets, you could sell those and use that cash to make up the shortfall and put on that roof. But if all else fails, you could just sell the asset. If the asset has so many expenses, it's just bleeding you dry, you could just sell it, and then you wouldn't have to pay any more expenses. But like, for example, if your IRA has a note and the borrower isn't paying, then you need to do collections. Well, you can't do that yourself because that's offering services to the plan. So your IRA can hire a third-party note servicer to do that debt collection for you. But your IRA would have to pay that expense. Gotcha.
Okay, makes sense. Cool.
We didn't talk about, by the way, precious metals.
Huh?
Everybody's got a little bit of that hanging around, and we've seen precious metals values kind of shooting up, and we might again. It might still go up, so we just don't know. But precious metals are another asset where we actually store the physical metal for the IRA account. And that's another asset class that people like. I think silver is around 30 an ounce right now, something like that. And gold is, in the thousands, couple thousand. So, but that's another asset class that we see a lot.
And you guys will actually store it?
Yeah, we store it at a place called Delaware Depository.
Okay.
And it's a pretty cool place, pretty buttoned down, and all kinds of surveillance.
Nice. That's awesome.
Can you imagine if that's your job, to play with gold and silver all day?
Yeah, just watch gold and silver.
Yeah.
That's pretty cool.
So that's what they do.
Nice. Matthew had one more question. He said, I expect that creating self-directed IRAs are also subject to one rollover per 365-day rule. Question.
Right. So let's talk about that. There's when you do an IRA to IRA transfer, that's called a direct transfer. But what Matthew's talking about is an indirect rollover. So if you've got an IRA, you take personal possession of the money, And then you take that money within 60 days and you put it back into an IRA account. It's called a 60-day rollover. It's called an indirect rollover. And you're right, with that IRA kind of indirect rollover, you're limited to one in a 12-month period for all your IRAs combined. So yes, indirect rollovers are limited to one for all IRAs combined in a 12-month period. That is absolutely right.
You can just do a direct rollover. I mean, like that's what I did. I had like just a regular Roth IRA with American funds, and I just did the paperwork between the two custodians, and they just transferred it over to uDirect, and it was super easy.
That's right. So direct rollover, no limit. Rolling over, no limit. So yes, cool. But it's when you have possession of it, and you want to put it back in an account. That's when you're limited. That changed a couple years ago.
Gotcha. Cool. Well, what else? Does anybody else have any other questions?
Well, while we're waiting for questions, I'll mention that, like I said before, we're in this new administration, right? And so what's going to change? And so far, the answer is nothing. I sit on the board of directors for the Retirement Industry Trust Association, and I love it for so many reasons. And one is because I get to hear from Washington, D.C., from the regulators what's happening. So there are a lot of proposed changes, nothing in cement yet. But the nice thing is I don't hear anything about actually changing the structure of the retirement industry. You just don't know what's going to change. I'm not seeing any structural changes, but a lot of like augmentation where, for example, that maybe healthcare workers will be able to get a catch-up contribution. And that's what you get now if you're 50 or older. So instead of just a $6,000 contribution to your traditional Roth, now you get to have catch-up contribution and add an extra $1,000. So now you can put in $7,000 a year. So maybe adding that, a couple other things. What else were they talking about? Well, it just hasn't happened yet. So we're going to see how it all rolls out. Another thing is perhaps instead of getting a tax deduction for making a contribution, you get a tax credit. So that's a little tax, that's something that's not happening, but it's been talked about in the early days about, hey, Biden's running for president. What are some of his ideas? These are some of the initial ideas, but my experience is that these things are really slow to move. We'll see what comes about. There's an annual meeting of the industry coming up a month from now, and where we're going to be delving deep into this, talking to the Department of Treasury, talking to the Department of Labor, and what's the people from there, what's going on, and to see if anything has changed. And if it has, we'll be writing blog articles about it, and that'll be on the uDirect blog right away. And if you want to get on our mailing list to learn more about what some of these things, you can go to uDirect, and there's a pop-up right away that'll say, hey, put your email in there, and you'll be joining our mailing list there, and then you'll find out what's happening. I think we have some questions there.
Yeah, there you go. Nick says, can an IRA be a general partner in an LP?
No, because who's going to speak for it? It's an inert thing. So the answer is no. That is, that can be surprising, but the answer is no on that one. What also an IRA doesn't do is invest in a joint venture. You can have a joint venture, but a joint venture isn't an asset in and of itself. It's just an agreement.
Right.
But so if you're going to JV, that's fine, but a JV is not an asset.
Okay.
A note is an asset, but not a joint.
Right. Matthew says, can a direct rollover be for a portion of an existing IRA, or does it have to be for the whole?
It can absolutely be partial. One thing that the number one mistake people make when they're doing a partial, rollover, our IRA to IRA transfer, we call it, is not transferring enough. So if you say you're going to invest in a private placement, $50,000. If you just transfer over $50,000, you won't have enough because you need to leave a pad for fees, or if you're going to do any, like wire fees or account fees. So you need to leave a pad so that you make sure you've got enough to invest. But yes, you can do partial.
Yeah, and I'll say I did a lot of my own research on like fee structures, and I'll tell you that uDirect is one of the best when it comes to actual fee structures. I did my research, and they are by far one of the better ones for sure. So thank you for that, Kaaren.
No immediate plans to change that, so that's good news.
Yeah, that is good news. Let's see, what else? Anybody else have any questions? If you can jump on the mic if you want. We don't have that many people on, so Anybody else?
Direct rollover for a portion. Okay. Oh, if I break up an IRA into 3 chunks and decide to roll 2 of them into separate self-directed IRA accounts, yeah, you can do that. If you've got one big account you want to put into 3 different accounts, you can absolutely do that. Absolutely do that. No problem at all.
So here's kind of so is there anybody that shouldn't direct their IRA? Why would you not want to direct an IRA?
Well, understand that a self-directed IRA is a tool to use. So we don't sell any assets at all. It's all self-directed. So you're choosing the assets. So if you're not familiar with alternative assets of some sort, it's not for you, because it's very precious money. It's really hard to save self-directed IRA money, retirement money, because you're limited. You can't just have a windfall and put a whole bunch of money in the account. You can only put in so much per year. So it's you earn it and it builds up over time. So it's very precious. And you just want to make sure that you know what you're doing and that you really understand your asset class before you go in, or that you invest with somebody who really understands their asset class. In fact, you bring up a point that I'd like to kind of just sit on for a second, or just kind of park here for a moment, and that's due diligence. So like Stu, when you invest, how do you do your due diligence? I mean, you're not just going to throw some money at people, are you? You're going to check them out, aren't you?
I used to, but I learned my lesson the hard way. But yeah, I mean, there's a lot of due diligence. I think for me, most importantly is just knowing who the person is and knowing their values, knowing their experience level, and how many deals they've done. Learning more about the individual and the person and their core values behind who they are before I invest with anybody.
Yeah, and did you talk to some of their previous investors?
Oh yeah, yep. Get references, see who else they've done business with, for sure.
That's playing to win right there. That is playing to win. I mean, we don't see a lot of fraud, but we do see some. And so there are organizations like NASA, which is with an extra A, which is Securities Administrators, so they have a website, SEC, FINRA, 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 another regulatory agency, even AARP. If you go to their websites, you can find bad actors. We had that happen recently where someone was going to be investing with someone. So we don't always do this, but there was something that didn't look quite right. And so we checked them out on the SEC's website. We saw that this asset sponsor was not just, first they were suspended by the SEC from doing business. And then we looked again like a week later and they were barred. Wow. So, and we had several account holders that wanted to invest with them. Well, they're barred. So we're not advisory. So we don't say if it's a good or bad investment, but if we tell you that something is not administratively feasible, that's kind of a non-answer to say that is an asset. We're going to make a business decision not to custody that asset. For what reason? Well, because it's not administratively feasible. We really can't say. But you definitely want to check out people, especially when you're investing in a what's called a security. Sometimes notes are a security, sometimes private placements are a security.
Matt asked what the fee structure is typically for.
I paid Matt to ask me all these questions.
Yeah, you did.
So thanks, Matt. The typical fee, the fee structures, like you say, are all over the board. A $50 setup fee is pretty typical. That's what we charge. That's pretty much the only thing that's about the same. And then it goes off into all these different variations. Some will charge like a flat fee, plus if it's real estate, there's a hit, or if it's a note, it's a hit, so like plus extra fees, or some will charge based on the value of the account. So if you have 100,000, it's one thing. If you have $1 million, it's higher. But we don't do that because it's the same work. It's just, zeros. It doesn't we're not lifting more weight. So we charge a flat fee of $275 regardless of the number of assets and regardless of their value. So that's, so you'll see all different kinds of fee structures. And that's what we do. We offer the first 6 transactions for the lifetime of the account for free. The first 12 incoming checks per year at no charge. Otherwise, it's $10 a check. So our fees really are low. And I think that's probably, why one of the reasons people really love us, plus our service. We have a lot of great reviews.
Yeah, so I own quite a few mortgage notes inside my IRA, and they all are serviced through a third-party servicing company. Mm-hmm. And they service all the debt, and then they just take it and and then, transfer it right to the IRA account. And it's awesome. It's like completely hands off. And it's just, I think that's the best way to do it for sure.
Well, it's truly passive investing, right? You can go out and do something else while all this is churning for you.
Yep. Yeah. And I would say, to your point about kind of being knowledgeable about investments, there's a lot of people that have self-directed IRAs and they get it all set up, but then they don't have an opportunity, and then their money is just sitting in an IRA. And when it's just sitting in an IRA, not invested, it's earning pretty much zero. Right?
Well, 1/10%, that's about as close to zero as you get.
Yeah. So,
that's
so you have to be
right.
So you have to be actively using it and investing it and looking for opportunities. But on the other side, when you are looking for money and raising money, there's a lot of people with self-directed IRAs that have money just sitting there doing nothing. So
that's true.
It's an opportunity to talk to investors about what they're doing with their IRAs.
And you bring up a good point too. So let's talk about this. If your IRA has brick and mortar real estate, like a physical building, you're going to want to leave a 10% pad of idle cash in there because, again, all expenses have to be paid for by the IRA, and it can't come out of pocket. So unless you have other IRA accounts, where you could just move the money in really quickly, like stock market accounts, you definitely want to leave that 10% pad in there. That's super important.
Yeah, for sure.
That surprises a lot of people. That's pretty critical.
Yeah.
And by the way, the idle cash, it's only earning 1/10%, but what's nice is that it's not at risk in the market. I know, especially like in 2008, I remember when I was working, I was at a different company before I started uDirect, when everything just went down 40%. We had thousands of account holders sitting on idle cash that didn't budge. It didn't participate in the upside, but at that time it was a downside, and so they didn't lose their cash. So there's that one caveat. It's not at risk in the market.
Yeah. Well, what else? Anything else, guys and gals? David, you've been quiet. You got anything? You just learning?
Just learning, man. Just learning. Trying to figure out how I can have you invest in me again, Stu.
Yeah. So, Kaaren, David and I are 50-50 business partners. I can't take my IRA and invest in him, correct?
Technically, no. Yeah.
You said technically. What is that? We're in the Navy where everything is waiverable. What does that mean?
It means you're disallowed to each other, but you can invest together concurrently.
So like a husband and wife?
Kind of.
For the record, that's how we do most of our decision making anyways.
We got some laughing people there in the background. Kind of not like husband and wife, kind of like business partners.
Okay.
I like that better.
Our wives accuse us of otherwise, but that's awesome.
Best friends are not disallowed, but 50-50 business partners. Yeah, you got to watch that. Because again, they don't want you to have any personal benefit or, like that. Now, here's the thing that people will do, which is, in the olden days, there were so many things that were not looked at, but as we move forward, regulators are looking more and more at the self-directed IRA industry and what happens. So one of the things that you used to be able to do, you really shouldn't do now is here are the two of you, right? So you've got a condo in this building and you've got a condo in this building. Like say, for example, it's where you like to vacation. So maybe Hawaii, or I don't know, maybe it's on the slopes or something at Vail. You each have a condo at Vail.
Right.
So your IRA owns one condo at Vail, his IRA owns the other condo in Vail, and you stay in each other's condo, so you're not having personal use of your own IRA-owned assets. Yeah.
I like
People
that.
think they're smart. No, because then you're getting personal benefit. Because
you don't like that, Stu. You don't like that.
I mean,
yeah.
And now that's not just a transaction within a business entity. That's period, right? If you are business partners, there is no way to, as best friends, hypothetically, invest outside of an established LLC or otherwise. I mean, the fact that you are business partners in a specific LLC precludes you from any kind of joint transaction. Is that right?
It does. Yeah. So you're not going. So you can invest concurrently, but as 50-50 business partners, you're not going to invest in something that Stu personally owns.
Gotcha.
Right. Yeah.
How many degrees of separation from Kevin Bacon is in an IRA? I mean, how many degrees of separation have to exist between IRAs and IRA owned LLCs?
Yeah, right. Well, it's just those are the lines of prohibited transactions. You just don't play games with them. You keep away from those people. But no, we get asked a lot of crazy questions. This morning, I got a call from somebody, the sweetest lady in the world, and she's like, "Oh, I heard that she thought that I had taken an IRA and went and took it from $500 to $20,000, and she thought I did this, which I didn't." And she's just so sweet though. And I said, "Well, so you wanted?" So she was, "I have $500. I want to do this." So first off, she didn't have a job, so I think we have to say that you can't contribute to an IRA unless you have a job. You have to have active income even to make a contribution. So she didn't, so she couldn't do that. And so her dreams of taking her $500 and turning it into 20K didn't come into fruition. But also too, there are fees and so forth. So you definitely need more than $500. But you can invest in options. That's another thing where people have taken small IRAs and turned them into big IRAs using options. Yeah. When you do that, you want to be careful of what's called Roth fraud. That is a big, buzzword with the Department of Treasury. If you've got a Roth that today is worth $1,000, and then next year when the value is established with the IRS, they're like, "Whoa, look at that! Look how much it grew." In 1 year, you might get a phone call from the IRS, or actually, they don't call you; they send you a letter, and right. And you'll get a letter from them saying, "Hey, let's just talk about this gain in your Roth," because they want to make sure it's legitimate. You're not, dodging your tax obligation to them. So,
Josh asks, "What if it's an arm's length transaction, i.e., you rent your own property from a third-party rental company?"
No, that's not third party. Who owns it? So here's the thing. So if you own the property, that's one thing. Even if you have an LLC that owns the property, that's still you. And right, so you can't do that. If you can't do it directly, you can't do it indirectly. They even it's called the Indirect Rule that says that. We had an appraiser who wanted to loan money to his to a friend or to his aunt. And I said, "Well, great. Well, what's your aunt going to do when she gets the money?" He says, "Oh, she's going to invest in my company." So he was going to get indirect benefit. The money was going to go from him to his aunt and from his aunt into his own company, which he would draw a salary from or earn a profit from. So that indirect stuff is also disallowed. It's fun to talk about the rules and what you can't do.
Yeah.
So but the truth of it is there's so much more you can do. Again, like, rental properties and, have tenants and so you can screen the tenant, you can choose the property, you can screen the tenant, you can pick up and physically collect the rent check that's payable to the IRA. You can do all these things. You can't take a fee for managing the property, and you're not going to swing the hammers or do any of the work, but you can effectively property manage your own, as long as you're hiring third-party vendors, you can manage your own IRA on properties. That's good to know.
Hey, may I ask, just to follow up on that? This is Josh. I asked the question.
Hey, Josh.
So yeah, you need to be passively involved in it. So that's what I'm saying. So let's say I have a rental property, but I have a third-party property management company. I can't go to that third party as if I'm anybody else and rent the same property, even though it's an arm's length transaction.
No, because of the ownership. So the trail is who owns it. So they're just a service provider, but you're the owner. So that would not be okay.
Okay, got it. Okay, sounds good. Thank you. One other question. I'm sorry, I joined late, so I'm not sure if you covered this, but are you able to do loans as if, I know you can do loans in a traditional 401k, depending on the situation. My understanding is you can do loans in a self-directed as well. Is that right?
Well, let's talk about that. When you've got a 401k or a 403b or something like this with an employer, you can take a personal loan from that. We call it an ERISA plan. It's like an employer plan. And you're allowed to do that. But you can't take a personal loan from an IRA. So if you're talking about a personal loan to yourself, you can't, it's disallowed from it's just a withdrawal that you'd pay taxes and penalties on. So you're not going to take any money personally, but your IRA could loan money to David and Stu, and then they could pay your IRA back because, you're not married to them and they're not your parents or your kids. You know what I'm saying? You're a 50-50 business partner. So that would be okay. Lending money, the business of lending money and making loans is okay, but not to yourself.
Josh, David and I will take your money from your IRA any day you want to lend it. We'll give you a heck of a really good interest rate, maybe like 6%. Does that sound good?
That sounds great.
Cool.
Don't worry, I won't do any due diligence. I trust you guys.
Yeah, thanks, man.
I got a story. You want to hear a due diligence story if we have a few minutes?
Yeah.
Okay. So there was somebody local to Orange County, California, where I'm at, and they ran a real estate investment club. And so people trusted them so much that they didn't really do their due diligence. And what happened was, I'll say, for example, like hypothetically, this is what happened. So like, here's this house, right? There's a house. So they say, hey, why don't you and you and you make 100% lien on my house? So if they did any due diligence, they just checked to see, well, who owns it? It's like, oh yeah, well, they own the house, so they totally own it. So what they did is they were taking this money from other people, but never recording their lien.
Oh, nice.
And so these people were highly trusted. And so nobody bothered to do I can say this word. They didn't bother to do the due diligence on the back end and make sure that their loan actually got recorded. Their lien position was actually official. And they lost some money, and those people are actually in jail.
That's no good.
You mentioned earlier, if you're an investor, if you're like an LP in a syndication, and the tax, if you take debt onto the purchase, is there a proportion of the tax that would be, commensurate it with what you invested in the deal, or is it, how does that work? Because that's a lot of the, what's that?
It would be pro rata, but that's a good question to ask your CPA about how that's all broken up. But you'd pay, you would owe UDFI tax based on your IRA's pro rata ownership of the asset.
Okay.
Gotcha. So you own one share of it, like one 40th% of the asset, then you just get that portion of it.
It would be pretty, we call it de minimis.
Yeah.
It'd be pretty small.
Yeah. Gotcha. So, if there's no other major questions, I'll kind of just end with this. We're getting close to the hour mark. So if I am raising capital and I'm talking to investors, and, an investor that I'm talking to, I tell them ask them if you have an IRA and you have money in there, would you be interested in investing with your IRA? But they just have like the traditional IRA with, a regular like Fidelity or something like that. Mm-hmm. What are the steps that I would help them through to get from a Fidelity IRA to moving over to a uDirect IRA, so then that they can come invest with me? And how long is that process?
Yeah, sure. All you'd need to do is really just introduce them to us, and then we would take it from there. But it's a 3-step process. Open the account. The next step in the next process is funding the account and then investing. So opening the account, we need an application and a W-4 form. We have you fill that out, and copy of your driver's license, that kind of stuff that you'd expect. We get the account open the same day. So that's how long it takes. Same day we get all those things, your account's open. Now we want to move the money. So if it's an IRA, you fill out our transfer form and you sign it, and you give it to us and we sign it. We send it to them. It'll take about a week to get your money over. So if you're in a hurry, you definitely want to tell them to wire the money. That's an option. Okay. Gotcha. Checks have a 10-day hold. So wiring is faster. But if it's a 401k or what we call an ERISA plan, like a 403b or 457 or something, or from the military 457s, if you don't work, if you're not there anymore and you're going to roll it over, then you don't fill out our paperwork. You call the plan administrator from the old employer plan and fill out their paperwork, and then they'll send a check over. You don't really have a choice. They usually don't wire. They will definitely send a check. So that's how you get it funded, or you can contribute. So you've opened the account, it took a day. Funding the account tops 2 weeks, unless there's some glitch or you didn't fill out the paperwork correctly and it got rejected or something. But it's 2 weeks max. Usually a week is what you can expect to get it funded if everything goes well. So you open fund, and then once your money's there, if you've got a deal, we can be looking at that deal while we're waiting for the money to come in, so we can just hit it and fund it when the money comes in and get it all approved. But if your account's already funded, it's usually a 24 to 48 hour turnaround to get that deal funded. So it's pretty quick. We're pretty quick. And that's another thing people really like about us is, not wasting time.
Yeah, it's super easy. Like once you have the account open and you find an investment, you just upload the paperwork, give the direct investment form, give the wire instructions, and it's pretty much done. So. And
we have a staff of trained experts, all that come from basically the real estate industry, that can answer your questions and understand your deals and so forth. We don't drop any of the legal paperwork for your deals or tell you what to invest in or anything like that. But when it comes to all the self-directed IRA questions, our staff is well seasoned.
Yeah. And Matthew, last question here. What is the typical size of newly opened self-directed IRAs?
Well, there's it's all over the board. I'd say our average account size is about $130,000 of the 6,000 accounts we have. That's about where it stands. Roughly. But it just, it depends. There's no such thing as a small IRA. It's just you have to have a big investor heart and grow it, right?
Yeah, that's right.
There are some of these guys that are out there that are the gurus, and one of them I interviewed. And at the beginning, when he was really young, he would make little microloans out of his Roth IRA to mobile home owners, or whatever, make these little microloans. And he built up his Roth. He has $1 million in his Roth now.
Wow.
So he started off with a little account and really turned it into something out of his own, hard work.
That's awesome.
So
awesome.
Very cool. Well, Kaaren, I really appreciate you coming on. I know you're a busy woman, and it's good to see you. I learned something tonight. I know everyone else did, and I really appreciate you coming on. What's the best way to get a hold of you? Just through the website, or I know you gave your email address, and I'll put that on there. Is that the best way?
It really is. Yeah, info at. You can call us. uDirectIRA.com is our website. It's full of great information. We have something called a library where you can read all sorts of things, and we didn't get into crypto or anything like that. That's some of these fringe things that are out there too. But there are just a lot of questions, or just pick up the phone and call us. We're happy to talk to you and find out about your questions. And
awesome.
Is it prohibited? That kind of thing.
Yeah. Okay. Well, again, thank you so much. David and I, we use private lenders a lot for our deals, and they have, I know quite a few that have uDirect accounts, and they send money to us to do private lending. We have people that have joined our syndications with their self-directed IRAs. And so it's an awesome tool, and it's just something else to have in your tool belt. So if you guys have any questions on here for David and I, please feel free to reach out. I'll send a replay of this webinar on a recording to everybody. And so reach out to Kaaren, reach out to us, and I hope you guys learned something tonight. And thanks for joining us.
Thank you, guys.
Yeah. Thanks, Kaaren.
Thank you, Kaaren. Appreciate it. It was awesome.